Hey, this is Sasha. Thanks for joining me in today's video. And what I want to share with you today is really some insight on a question somebody had is, hey, about spreads. Wouldn't a spread be better, like a vertical spread, rather than an iron condor? Because an iron condor has risks in both directions. You can get, in a little trouble on both sides, whereas a vertical, you got risks in a single direction. So stay tuned. I'm going to share with you some thoughts and insights about this right now. All right, so before we kick things off, remember we have a great getting started page at tradersfly.com, and there's also a ton of freebies you can download. So go ahead and check out our website, and you can help support us through paying the employees and the team that I have through the courses, books, and much more. So here's the question here, comes in from Sam just not too long ago. So I went ahead and I thought I'd go ahead and record a quick little video about this because I was recording some things. Anyway, an iron condor loses money if the stock moves too far in either direction, right? Because when you look at an iron condor, here is our iron condor trade and our setup. And if we got price right here, well, if you go over here, you're in trouble. If you go over here, you're in trouble. But a spread loses money only if the stock moves in one direction. So a spread is basically, let's just take one side, loses money only in a single direction. Wouldn't that make the spread better strategy? And my answer is, well, iron condor has a faster theta decay. Wouldn't that make the iron condor better? Not really. Neither is better. It really comes down to the pros and cons you want. So I think it's important to understand that, some people think which strategy is better. What is the better strategy? Is that strategy better than that strategy? And it's not that one strategy is better than the other. That's the big picture that I want to share with you. Not one strategy is better than another strategy. It's just that certain strategies have different types of risks involved or different kinds of pros and cons. So as we look to getting into this, what he's saying is, and not to pick on Sam, all we're talking about is here is a spread. Let's say we sell a vertical on Facebook, and we look to this vertical, and I go from the 190 to, let's say, 160. Here I've got my vertical, and I could bring it in a little bit, let's say 210 and 180. So here I've got a vertical. Wouldn't this spread be better? Because I got no risk on the upside, but I've got downside risk. So wouldn't that make this better? Well, yes and no, but now you've got a further increased downside risk. Why? You've got a 13 delta. So as this pulls back, that means you're losing $13 for every dollar move to the downside. So why wouldn't you then in this case do a counter argument saying, well, why don't I go ahead and do something like, here is a 30-point difference on the call side. And now I've got let's just go even further out. Now we could do like a custom iron condor a little bit. Why wouldn't I reduce this? Now I don't have the pricing problem. Now I've got a -1 delta. So now I don't mind if the stock stands still. So you're thinking, well, what if it just goes up? Well, that's a risk there. Well, why couldn't I go ahead and have more contracts on one side versus the other? You could do that. Or here, what's the advantage to doing an iron condor? Well, look at my theta. My time decay, I've got 9. Whereas if I just do the vertical, I got 4. I got almost twice the time decay if I do an iron condor. So it's a trade-off. Yeah, you are limited now. You have risks in both directions, but you've got a faster theta. So you could get out of this trade faster. So you could be in the trade a lot less. So I could be in this trade a little bit and then I get out. Or I could have put a little more capital in one area, let's say the puts, and less capital in the other if you still wanted more upside room or exposure, or vice versa if you want a downside. But here, in this case, if I wanted some upside exposure and a less of a double area problem, meaning on the calls and the puts problem, I could just reduce my risk in one of the directions and still increase my amount of contracts, but again, you're ramping up your delta. So now if I go ahead and increase the verticals here on the call side, I could reduce my deltas in that case. So it's all really just about which one is better than the other. It's not that a single vertical is better because, the reason you're saying is, because it only has risks in one direction. That's not the case. Yeah, it's true that it might be better from that standpoint, but what's the trade-off? The trade-off is you are making less on a time basis, okay? And not to mention, look at the margin requirements. So let's say I go ahead, let's just do one contract. You're using more capital in a way to put on a vertical. Why? Well, watch what happens. If I put on a single contract, I'm using $2,619. If I go ahead and put on another vertical over here, I'm using right here, what is that? That's 6 contracts. Let's go to 1. I'm using $2,664. Now together, what I want you to realize and recognize here is I'm using, take a look. If I just put on this single vertical put spread, I'm using $2,619. Think about it. Now I put the other one on, I'm using less capital, $2,280. Less money to potentially, look at what you're making. You can make, not that it always pans out, you can make $717, okay? Versus with just the vertical, you make $381. So you're able to make more, you're using less money, and you have a faster theta if you're doing an iron condor, okay? If you're doing an iron condor, you have a faster theta. You're able to make more, you use less capital, and you have a faster theta. The downside is you have risks in both sides instead of one. So yeah, there is a little trade-off, but it doesn't mean that one is better than the other. So I can make the counter argument there, this is better. Well, yeah, you use more capital, but you don't have the risk in this direction. So it really just depends on the pros and cons. It's not that one trade is better than the other. It's that it depends on what you're trying to do and where does that trade fit. This one has a faster delta to the upside. So if this pops, and this is in your long portfolio concept, if this pops and heads higher, you could take this trade-off very quickly. On the other hand, if this pops, you can't take the trade-off very quickly. So there is a trade-off. There's a trade-off. It's not that one is better. It's just which advantage and disadvantage do you want to deal with. Anyways, I hope this was helpful, gave you some things to think about, because a lot of people, they get into these kinds of things and they wonder, hey, which trade is better? And I really appreciate you guys sending in comments. Thank you so much, Sam, by the way. It's not that I'm picking on you. I'm just using your question as a way to educate and understand that it's not that one is better. If you look at it from that perspective, I think it's a good starting point, but understand it's not that one trade is better than the other. It's that we have pros and cons of which is better. Similar to, do you prefer a Toyota Camry? Is this car the best car in the world? No, maybe, I don't know. Some people say the Ferrari is better. Okay, why is that better? Well, can you sit 6 kids in here? No, probably not. What about a Honda Odyssey? Well, in that case, if you got 4 to 5 kids, this is a better car than the Ferrari or the Honda Civic. So better is all relative. So that's what I want you to think about as you look at trade strategies and ideas. It really just depends on what you're trying to do and where does that trade fit. So thank you so much for joining me. Hope you enjoyed the video. Feel free to subscribe to the YouTube channel, download some files, and see more great videos. Thanks again, and I will see you next time.